Good day, everyone. It's the founder and CEO of Pilara Solutions Accountants. Today, I would like to talk to you again about something very, very important concerning small businesses. You would remember from our last video, we were talking about the importance of having cash in your pocket as a small business. So today I would like to just elaborate further on that subject that we discussed. Was it last week? Yes, I think so. And let me just tell you the reason why I want to talk to you about this important topic today, subject today, is because a lot of small businesses, especially small businesses that I've seen around, most of them they still don't understand why every time when they apply for credit, they are still getting declined by the banks, and every time when they apply for funding, let's say from other financial institutions or from government institutions like your CIFA and other funding institutions, they still don't know why they always get declines, whereas they have been running businesses for quite some time. But one of the reasons why you are getting indications, it's because you do not know your numbers, all right? If you do not know your numbers, it's going to be very, very, very difficult for you to even build a valuable business. So for you to be able to build a valuable business, the first thing that you need to know is your numbers. You really, really need to know your numbers if you are serious about building a valuable business. A valuable business is a business that somebody can actually look at and be able to predict its future. All right, so that's a valuable business, and it's very, very important because if you know your numbers, you will know exactly what to do. Like for instance, I always tell people that if you want to make more money, if you want to obviously expand your bottom line, the first thing that you need to do is to increase your revenue. Your revenue is the total amount of money that you've made from your sales. All right, it could be credit and cash sales, but that's a total combined. And now the other thing that you can do is to reduce your expenses, right? So if the reduction of your expenses can also expand your bottom line, which is your net profit. So it is very, very important for you to know exactly. You cannot deal with something that you do not recognize. Like I always tell people that for you to start dealing with a problem, you have to admit first that there's a problem that exists. So for you to know, to be able to increase your revenue, you have to know your numbers. You have to know exactly the amount of money that you've been spending or that you want to spend. So that you want to earn. All right. So your revenue, if you want to increase your revenue, you need to know exactly by how much. All right. You cannot just want to increase your revenue for the sake of increasing your revenue. And that is where some people end up finding themselves getting into contracts that are not profitable because they just want to keep themselves busy. They just want to see themselves in business. They just want to see themselves running some sort of business. But if you look at the contracts that they service, you find that these are not profitable contracts, and mainly it's because our people don't know. They don't know their numbers. Some people, even when they have an accountant, every time when they have a meeting with the accountant, they just sign off the financials, and they really don't give much consideration to the financials and attention to the financials. So it is very, very important, good people, for us to know our numbers. You don't have to know your numbers like your bookkeeper or your accountant. We are not expecting you to do that, but at least know the amount. Just know the basics. Know what is your income statement, or like it's called nowadays, it's called, I think, a statement of profit and loss. And you must know also your statement of financial position, all right? And you must know what it does, why is it important, and you must know also your cash flow statement. So today we are going to focus just a bit on the cash flow statement. But before we get to the cash flow statement, let me just define the first two statements. There's a fourth one, which is called the statement of equity, but we are not going to touch it at all today. But let me just define what your income statement is. If you have a car, let's say you have a Mercedes-Benz, or you have let's say a Golf 7, all right? So you need to know the performance of your car, right? You need to know the performance of your car and the health of your car. So the performance of the car and the health of the car is not the same thing. So you need to know, after performing, we need to, observing the performance of the car, you need to now look at the health of the car, all right? If you've been driving, let's say, high speeds of 220 per hour on your N14, N12, N1, on your national roads, after a particular period, when you look at the status of your car, what does it say? Or when you look at the health of your car, what does it say? So basically your income statement or your statement of profit and loss talks to the performance of your company, all right? And then your statement of financial position now talks to the health of your company, all right? We need to check, after observing the activities of your company, your performance of your company. Now, how is your company? How does your company look in terms of its health? The mileage of the car now and the engine. That's when we look at all of that, so that we can check if we need to service the car, if there is only oil change that is important, and or if you also need to really. Buy new tires and all of that. So it's very, very important to check your balance sheet after looking at your income statement. Some people, when you tell them as their accountant that, look, you've actually made a profit of, let's say, 1 million, they don't understand, like, how did I make 1 million? I don't have 1 million in my bank account, and I've never had 1 million in my bank account. And you cannot be telling me that I made 1 million. I'm so broke. Even if you can look at my bank statement, you can see that I'm actually running at an overdraft. So how is it possible that I can make a $1 million profit, but at this juncture I don't have anything to show? Now that's where the cash flow statement comes in. Now you need to know that on your income statement, good people, there's what we call cash and non-cash items. All right, there's a reason why the amount, your bottom line, might not correspond with your net cash, or the cash on hand that you have, or the net change in cash that you see on your cash flow statement. So it is very, very important. Like, you have your non-cash items. Non-cash items, we're talking about items that had to be taken into account when preparing your income statement or your statement of profit and loss. We're talking about items like your depreciation. And remember, in the income statement, we also record, we don't only record cash items. Like you'd find that maybe you made sales of about 50 million rands, but out of that 50 million rands, you have a book value, your debtors book value is about 40 million, and then it means only 10 million rands was actually in cash, right? Although you've made sales of 50 million, it doesn't necessarily that you've received 50 million. You could have made sales of 50 million, but you only received cash of, let's say, 10 million. And then when you get to your expenses, because maybe your suppliers are not debt friendly, or you don't have good trading terms with your suppliers, you have to pay everything. I mean, things like your salaries, they have to be paid. Your telecom has to be paid. You can't be saying to telecom, now we need to negotiate because I didn't get all of my receipts from my clients. So this is where the cash and non-cash items come in. And in the income statement, you must remember that sometimes you will have gains and losses that are also not cash items. Like, for instance, the performance of the stock in the market. All right, there's a lot of things that are taken into account when preparing the statement of profit and loss. The things that are going to impact the performance of your company, but they do not necessarily mean anything to the cash that you have on hand. Now, your cash flow statement, all right, your cash flow statement has three activities, all right, three main activities. I'm going to discuss these three activities very quickly because I don't want to run this video for more than 15 minutes, all right? Now, the first activity is the cash from operating activities. All right, the cash from operating activities. That's the first one. Let me change this marker. So that's your cash from operating activities. All right. So now the cash from operating activities consists in the cash flow statement. By the way, good people, on the cash flow statement, the only things that you are going to see on your cash flow statement are those items that directly, in fact, that have actually impacted your bank account. All right, those are the only items that you are going to see on the cash flow statement, and that is why a lot of investors and funders, including financial institutions, they do not only look at the performance of your company, which is the statement of profit and loss, and they don't only look at your including the health of the company, which is the statement of financial position. They also look at your cash flow activities. All right, so the second element, okay, the first element is your cash flow from operating activities. All right, your operating activities, we're talking about your sales, your actual cash sales. All right, your salaries, suppliers, and everything. So on your cash operating activities, when the net, I mean, when we have a positive effect, well, how do I call it? If your cash flow from operating activities give you a positive net effect, all right, if your cash flow from operating activities give you a positive net effect, it means your company is doing well in terms of its operations. All right, so it is very, very important to check that, like your cash sales minus your salaries, suppliers, and all of that. Those are those are the items that actually make up your operating activities. All right. Now, there's another one called the second element is called cash from investing activities. All right, cash flow from cash from investing activities. So when we're talking about cash from investing activities, what are we talking about, or what are we referring to? We're talking about your investment in assets or sale of assets. We're talking these are your long-term assets. All right, any money or any amount of money that you have actually spent on your long-term assets, like your PPE, property, plant and equipment, like your vehicles, equipment, machinery, and all of that. Those your investments, they will be the net effect. The net effect of these will be affected directly by your long-term assets. So obviously, when you sell these assets, the net effect is positive, right? And when you buy these assets, the net effect is negative. So typically, your cash from investing activities, they will actually have a net effect which is negative, a negative net effect. The reason for that is because a lot of companies, any company would invest a lot in assets if they have money, or if they believe that those assets will bring them enough cash flows in the future. All right. So here, if you have a negative net effect of your investing activities, it doesn't necessarily mean something is bad, right? It doesn't necessarily mean something is not right in the company. It just means that they have invested in long-term assets. Now, maybe as an investor, you would want to now look at the items of PPE or the notes on the financial statements, your notes which deals with your equipment, machinery, and all of that, to check what was actually, how much was actually expended on that, and how much are you expecting based on what you see on the notes from all of the items, the PP items that we purchased. All right, so it is very, very important to understand that it doesn't necessarily mean that if it has a negative net effect, now it is something, it means something bad for the company. All right, so now in fact sometimes you have to be careful. All right, there's a balance here in accounting. Everything has to balance. So when there's a positive net effect on your investing activities, you ought to also ask your management or your CFO, right, why a positive net effect, or which assets did they now sell, because they could have sold assets that they were not supposed to sell. You remember, as the owner of the company, you send them and you believe in their expertise, but now you have to also look at the reports to check if they're performing well. All right, so the third element of the cash flow statement is your cash from financing activities. That's your cash from financing activities, right? That's your cash. The first one is cash from operating activities that deals with your sales, cash sales, suppliers, what else? All the cash items, right? And then from operating activities. And now on your investing activities, I'm talking about your PPE, and your other long-term investments, right? And then here on the cash from financing activities, now this talks to your loans, what else? Share buybacks, dividends, etc. All right, so it is very, very important to know all of these things and how they are linked to each other. Like, for instance, it's interesting, I've actually had somebody saying that the sales director or the marketing director, they normally the relationship with the CFO is not a friendly relationship in most cases, because the CFO wants to make sure that the net effect, the CFO is more concerned about this. The CFO is more concerned about the cash flow statement, and when the marketing director wants to maybe spend a lot of money in promoting the business and marketing the company so that they can increase sales, because I mean that's the reason why they are hired. I mean, the marketing director's job is to make sure that the sales are high, all right, and then the CFO now has to come and manage all of this and report to the board all of these things, how they impact on each other. Now you find that every time when the marketing director has to get a budget, they start fighting, because that one wants to have cash. The CFO wants to have cash on hand, and the marketing director is busy planning to just increase sales. And sometimes these sales are not even cash sales. So it is very important to understand all of these things, good people, how they gel in together. So now, sometimes the net effect here on your financing activities, all right, that's when you get money, when you the money that you get from your loans and so forth, all right. And sometimes you would find that some companies, they have a high net profit, all right. They have a high net profit, and then they declare the dividends to the directors, or let's say to the shareholders. And then after declaring the dividends, they don't have money, and then this is what they do. They go and apply for loan to come and finance the dividends. Now it is actually deceiving the shareholders, because now the shareholders are thinking that just because the company made a high net profit and the dividends were paid, it means everything is going well, only to find that the dividends was paid out of the cash from financing activities. So it means they've increased debt. So that is why you have to also look at your balance sheet or your statement of financial position to check if the debt has also increased from last year to this year, or from one period to another period in question. So good people, it is very, very important for you to understand these things, so that you can understand exactly what the bank wants, or what the financial institutions and the funders, government funders and other institutions, what their requirements are, what they are actually interested in, so that if you fail, let's say this year, you go and work exactly on a few things that you think could have impacted their decision, the bank's decision to decline you. So when you apply for loan, these people, they don't for a loan, they don't just look at the performance of the company. They drill down into a lot of other things to make sure, and they apply ratios. All right, the ratios, I mean, numbers never lie. So as soon as the ratios don't add up, then it's a decline. All right, regardless of how you think your business is doing and your potential contracts. Even if you have a huge contract that you are waiting for, that you need to service, that might actually turn around your company, it's not going to help if your company cannot even get finance. So it is very, very important, good people, to make sure for all your operating activities, your sales, make sure that you increase your cash sales. All right, make sure that you increase your cash sales. It's very, very, very important. And also make sure that, like I said last week, for you to have money, if you want to manage your cash cycle properly, pay your suppliers a bit later, negotiate with them, don't default on payments. I'm not saying that you should now go and pay them after 60 days, whereas the agreed period according to your contract and agreement is 30 days. Don't do that, but at least 30 days is not that bad. So it is very, very important, good people. Even with the idea PPE, you have to know, where does the money come from? I mean, on your investing activities, if it has a positive net effect, it means they sold something. All right, they sold long-term assets. So what was the reason? You have to be able to ask management or your board about the reasons why they ended up selling more of your long-term assets. And then also your financing activities. If your financing activities have a net effect, have a positive net effect, all right? If they have a positive net effect, positive doesn't necessarily mean good all the time, especially in accounting. If cash flow from financing activities has a net, it means they have maybe borrowed money, or maybe received money from the shareholders somehow. Maybe, but obviously as a shareholder, you obviously know if they came to you asking for money. But it could be that they have also given preference shares, because preference shares have different classes, and preference shares, the reason why they rank higher than ordinary shares in any company is because preference share is actually more of a loan. All right, so you ought to understand all of these concepts, good people, so that we can build valuable businesses. So that when we start talking about increasing the value of the company, you know exactly where you need to start building. If your net operating cash flow, or what do they call it, net change in cash flow, right? This is the last one, net change in cash flow, in cash, net change in cash. If it is positive, then it's great, all right? And if it is positive, and when you look at it in relation to your net profit, if the difference is not that much, then it means your management are doing a very good job, right? Provided that they haven't obviously applied for loans and all of that, debentures and all of that. So it is very, very important, good people, to understand all of these concepts in accounting. So sit down with your accountants and make sure it's important, make sure that you understand these things. You don't have to understand them like a pro, but understand what it means when they say a company is operating at a profit. All right, because some of you end up paying tax without knowing why you are paying tax, because you don't have anything in your bank account. But you need to know these things. You need, even planning can only be done if you know what you are planning to do. You cannot plan to do something that you do not have a base of. You need to have a base and then plan from the base going forward. All right, thank you very much